Well, there is a lot to track, so let's get the first opinion. And Neeraj Seth is CIO and head of APAC Fundamental Fixed Income at BlackRock. He's with us here in our studios. Neeraj, great to have you with us here. Thank you very much. And always good speaking face to face. So how are things looking, Neeraj? We had that big rate cut and markets have moved on. Are we starting a fresh leg higher? How would you describe it?
I think we are seeing the tailwind. And the big point here, because the markets are now in the debate of 25, 50, and we'll look back in time and say the more important point was that overall tide of the rate cycle had turned, which is very, very clear. So Fed is going to be easing from here. You still have probably another 150 basis points to go over the next 12 to 18 months. So from the overall economic perspective, if you think about it, US is moving towards a soft landing with lower rates. It's still a positive for risk assets. So I don't see a lot of risk in terms of the headwind at this point, unless something changes, whether it's geopolitics or US political standpoint. But for now, things are looking good.
There is no chatter. I mean, that is given. Soft landing is now the. I mean, it is the consensus, but there's no chatter about why there. I mean, GDP is still expected to grow at 3%. Stock markets are at new highs. Credit spreads are tight. I mean, so why 50 basis points? There's a large cut. So there's no question about around that.
Well, first of all, if you take a step back and think about where the Fed is from a real rates perspective, it's probably the highest we have seen in a very long time. And given the economy is slowing down, the unemployment is inching higher, the Fed has to bring the balance back in their equation of dual mandate of price stability and the full employment. So from that angle, it's more of a balancing move to bring the neutral rate back in equation rather than keeping the rates at a level where the real rates are very high. So I don't think it's a panic move, just to be clear. They could have started in July, bit of a catch-up.
You know, I was exactly thinking this. You read my mind, Neeraj, because it almost sounds too good to be true, because you have markets at all-time highs. You have a central bank that's moving ahead of any major financial crisis or economic shock. Elevated markets, cost of money getting cheaper, soft landing. It's very golden Goldilocks, right? What does that mean? I mean, how much higher for markets then?
So I think markets, from an equity market perspective, maybe you don't have a huge amount of runway similar to what we had in the last few years, because the Fed is still contracting the balance sheet. So if you take the equation of the Fed fund rates and the Fed's balance sheet, that is a combination of the two tools from a monetary policy perspective. But one more thing which people sometimes miss is the fiscal side. You still have fairly high fiscal deficit in the system, which is actually still going through generating jobs to some extent, obviously increasing incomes, and the liquidity in the market is still high. So yes, the markets still have potential upside, but I don't think it's as much as what we've gotten used to in the last few years.
You want to put a range to that? I mean, maybe for the US and then for India as well, but just a rough range of how much higher, given that we're at all-time highs already.
So it's always very dangerous to put ranges on the market, because I know I'll be wrong. We'll look back. But if I have to take a view, I think rather than having 15, 20% up, you're probably looking at more single-digit returns in the next 12 to 18 months, because the economy is going to slow down. I think that's also evident. Yes, the current data is showing strength, but we do need to be mindful of more medium horizon drivers of the economy, and that is gradually slowing down.
All right. Hi, Neeraj. Good to have you in the studio. What about the Chinese market? You know, the policy measures or the sound bites that are coming out of there this morning seem to be supportive for the economy as well as the stock market. That's the bombed out one. We've heard this before, but now it seems that they have some focus on there. Do you think the Chinese market from these levels could relatively outperform? Or do you think we've given them their chances, earnings visibility is not there, policy is not really played out? We'd rather stick to a market like India.
So what the Chinese regulators have done in terms of the reserve ratio requirement cut, which will release roughly 1 trillion renminbi of cash in the system or liquidity in the system, as well as the reverse rate cut, the key here is what they're doing is mainly focused on protecting the growth target. If you looked at the data that came out in the last few weeks, it was very clear that the 5% growth target for this year was looking difficult. Now, from a market perspective, I would argue the more important challenge facing the market is the sentiment. Alongside, obviously, the earnings growth visibility, the foreign capital leaving the market. But from a domestic perspective, the consumer sentiment continues to remain at the weakest level we have seen in decades. And that's driven more through a combination of the wage deflation in the system and the ongoing real estate weakness, and I don't think we're at the end of that real estate cycle. So would I be structurally changing my view? I don't think so.
And I think they're saying, did they say they're cutting? They cut or they're
They
saying two cut?
They've cut.
I saw this two cut.
Yeah, so they've cut by 50 basis points on the reserve ratio already, and they're saying there could be another 25 to 50 basis points going into the end of the year. Very similar to the Fed, holding that press conference saying this is what we've done and we'll probably do more.
By the way, there is a Bank of Japan press
Yes.
conference as well.
It is.
Any thoughts since we're talking central banks?
I think Bank of Japan is very important,
Yeah.
but given a combination of obviously what happened in August in terms of the markets post the last hike, and we're still very much having the LDP elections later this week, I think for now Bank of Japan is potentially on hold. I do think they will try to hike further, but it's not coming in a hurry. The experience in terms of the tightening of financial conditions in August did actually put a pause on their thinking of going aggressively with regards to normalization of policy.
And Neeraj, just to finish that point, India continues to outperform China even from here on?
I would think so. And again, I can't say for next 1 month, but if I take
Yeah.
a 5 to 10 year view, I think the structural story, and if you think about the combination of secular, structural, and the cyclical factors, they're all lining up in a positive way with the geopolitical tailwind. I do think the potential for markets, specifically the higher quality companies in the large cap space, I think there's still runway.
You know, I spoke with Jamie Dimon of JP Morgan yesterday evening, and I was asking him whether about this India-China question. It was interesting because we talk about in terms of financial markets,
Yeah.
right? But the larger point is government to government. There seems to be like this break in relations between the US and China, and that seems to be. I mean, the sense I got from that conversation will play out sound bites at 8:30. Is that it's kind of in a way irreversible. I mean, they're on opposite ends of the spectrum, as he put it. And, so the rise of industrial policy, I mean, industrial policy dictating where businesses should go. In that sense, I think India seems to be pretty well placed, right? As opposed to China or other markets in the region.
It's India's time, and all you want is we don't do a self-goal. I think otherwise things are looking good. The economy is on a great trajectory. The infrastructure build, digital, hard infrastructure. I think it's all very well aligned for structural growth story to stay for a while.
And what would you buy here? That's the troublesome question, right? When valuations are elevated, so much money is hitting the market.
So I'll start with what I would be cautious on. The small mid cap, I'm getting more cautious given what we have seen in terms of the rally. What you will buy, I think the whole energy transformation story, the new energy sectors, they still have a long way to go. The government target of 500 gigawatt by 2030, even if we don't get there, think of the growth trajectory that is required from here to 2030 for that. So that actually is an interesting sector. There are pockets of retail and consumer where you do see value. Banks, I'm getting closer to neutral because we've seen the best of the credit cleanup behind us, although I don't think we're at the beginning of a new credit cycle in terms of NPLs. But you're seeing some challenges in terms of loan to deposit ratios, deposits really in deficit. So I think there are sectors which are still in a secular trend, and you still want to be actually long in those sectors.
All right, Neeraj, thank you very much for joining us. Great speaking with you, and thank you for dropping by.